During the 2008 financial crisis, 1 euro was worth about 1.6 times the US dollar. Now, a combination of Europe's frontline exposure to Russia's war in Ukraine and the European Central Bank's reluctance in raising interest rates have driven euro and dollar nearer to parity or 1-to-1 ratio with the dollar. It's the first time the euro has sunk to this level in 20 years. So in today's video, I want to talk about why is the euro sinking? Is a weaker currency good or bad? Why 1-to-1 parity is important, and most importantly, how this parity could affect everyone. Hey friends, welcome back to the channel. My name is Essen. I'm a researcher, and on this channel we discuss business and finance in Germany. Let's begin with why is the euro sinking? The whole world has been affected by the war, but Europe is suffering the most. The EU imported approximately 155 cubic meters of natural gas from Russia in 2021. That amounts to about 40% of EU's total gas consumption, with the dependency rising to 65% in Germany. Some countries are totally dependent on Russia. Since the start of the war, sanctions on Russia have sparked an energy crisis which could lead to a potentially long and deep recession. This has also placed the European Central Bank in a very difficult situation, trying to curb inflation and cushion a slowing economy. At the same time, the US Federal Reserve is raising rates much faster than the EU area. That makes yields on US Treasury bonds higher than those on Europe's debt, driving investors to the dollar and away from the euro. On top of that, the dollar benefits from the status as a haven, meaning that as the war drags on and the fallout gets worse, the euro will keep sliding. But is having a weaker currency really that bad? Let's take the example of the Chinese yuan, which has been a currency peg since 1994. This approach keeps the value of the yuan low compared to other countries. As a consequence, Chinese exports are cheaper and therefore more attractive compared to those of other nations. For years, European policymakers have encouraged a weaker euro as a means to stimulate economic growth and make the euro bloc exports more competitive. But with extremely high inflation in the eurozone, a weaker euro is troublesome as it increases the prices even further by making imports more expensive. In June, euro area annual inflation jumped to 8.6%, up from 8.1% in May 2022. Bank of France governor highlighted a weaker euro as a risk to the central bank's goal to returning inflation to the average 2% in the midterm. So we have discussed why euro is dropping and why a weak euro is bad. But why is the euro-dollar parity so important? But before I tell you the importance of the euro-dollar parity, please hit the like button if you are liking this video so far and consider subscribing. Well, the answer is that it is a psychological threshold for the market. The first time euro fell to parity with the dollar was in December 1999, within 12 months of its inception. With both the currencies at the same level, a widening in the spread between Germany and US bond yields suggests an even stronger US growth. That said, the euro is still considered one of the world's key currencies for transaction and reserves. For the financial markets, currency traders expect turbulence given that billions of dollars in option bets are linked to this symbolic parity line, and it is very hard to predict how low the euro will fall. Just a couple of days ago, supplies via the Nord Stream 1 dropped to zero as the pipeline began a pre-planned 10-day maintenance period. But many are skeptical to whether Russia will resume the supply after these 10 days are over. If Russia escalates the crisis by withholding more gas supply to Europe, the euro could even slide to 90 US cents. The Fed has already delivered 150 basis points of interest rate hikes in just 3 months, while the ECB has yet to do anything. Reports suggest a 50 basis points increase in September, but nothing is certain at the moment. So at least in the short term, the euro will continue to slide down. So how can this affect you? Well, a weaker euro means expensive imports. In May of 2022, imports to Germany soared 33.6% year on year to $129 billion, surging the energy prices. Investor confidence in Germany's economy slumped to the lowest since 2001 as the country faces growing prospect of a recession. The situation has already led energy giant Uniper to ask the government for a bailout. As the largest German gas importer, Uniper is in severe pressure after the severe throttling of Russian gas supplies through the Nord Stream 1 pipeline. The company has to buy expensive gas to be able to service contracts with its customers. Now, Uniper plays a central role in Germany's energy supply and supplies more than 100 municipal utilities and industrial companies. That is why Germany and Uniper have been locked in talks for weeks over a potential rescue package. The company may need about 9 billion euros, more than twice its market value, as it bleeds cash trying to replace the Russian gas supply with higher priced alternatives. The company appears to be cranking up pressure on the government, warning that it could soon have no choice but to pull gas from storage, raise prices to customers, and even reduce supply. Electricity prices in Germany have already risen almost 40% over the past 12 months to an all-time high, and if there is no bailout for Uniper, energy prices may see another increase up to 100%. Germany is in ongoing talks about the Uniper bailout with Finland, which holds about 50% of Fortrum, the parent and majority shareholder of Uniper. Germany wants to get support from Finland for a potential bailout to ease the financial burden on taxpayers. Either way, it is a lose-lose situation for the taxpayers. On top of that, according to the head of German Federation of Trade Unions, entire industries are in danger of collapsing permanently because of the gas supply bottlenecks. Aluminum, glass, and the chemical industry more specifically. The chemical industry alone employs more than 350,000 people and is the third largest industry in Germany. Such a collapse could have massive consequences on the entire economy and jobs market in Germany. Due to the crisis, Germany moved into the second stage of a three-stage emergency gas plan last month. And if the situation worsens, Germany may start rationing natural gas in the last stage of the three-stage plan, as outlined by the economy minister. Under the current emergency plan, the industry would be the first in line for supply cuts. This move could devastate the economy and lead to massive job losses. That said, there is some positive news. Canada's government said that it would permit the return of a turbine to Germany that's needed to operate a key German pipeline, a step intended to ease the gas shortages. Additionally, there are plans to import LNG from Canada to help reduce the energy crisis. But a weakening euro means more expensive imports. So what can you do in this current situation? Well, you can try to increase your savings rate by following certain simple tips that I share in this video. Or you can add an additional income stream along with your full-time job, which I talk about in this video. So thanks for watching, bleib gesund, and I'll see you in this video.